Hi, everyone, and welcome back to AIADA's Auto Talk. I'm your host, Rachel Soleimani. A few quick reminders for our newer listeners. Anyone who is registered for today's program will be receiving a copy by early next week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Now, please join me in welcoming back our dear friend, Cox Automotive Senior Economist, Charlie Chesbrough. Charlie, I really do say this every time we have you on, but a lot has happened since we last had you speak to us in March. So I'm going to let you take it away.
Okay, well, thank you, Rachel. Yeah, sure, a lot sure has happened, and that's what I'm going to be talking about today. And that's the tariff impact that's coming ahead, and that's what we're looking at. We're kind of waiting on pins and needles for what it's going to mean for all of us. But I got a full agenda today. We're going to start by talking about the economic and automotive outlook. And then I'm going to get into a little bit of a deeper dive on tariffs and what the application of them is going to mean. And then I'm going to talk about what we're seeing in the marketplace today and what the impact has been so far. And we are starting to see some signs of how consumers are changing some of their behaviors here in the wake of these tariffs. But I was trying to figure out how to kind of summarize what the economic outlook was with a picture. And this kind of came to mind of showing the old ship, the Titanic. And that kind of represents new vehicle sales of where we are today. And dead ahead is the summer of 2025. And that may end up being a big iceberg here. And we're all, us analysts that kind of follow the industry, are just waiting to see how does the economy and how do vehicle buyers react here over the next couple of months, because things are going to start to change out there. So just to give you the summary up front, the outlook right now is that the economy looks strong. The vehicle market looks very strong today. Sales have been strong the last couple of months, and we'll go through that. The economy has been creating jobs, and I'll show you some slides on that. But it's tomorrow that everybody is worried about. It's what happens next. And that's because the tariffs that were put in place at the beginning of April are going to start to have real ramifications for product availability, possibly production, all kinds of things that are going to be ahead of us here. And one of the things that we know is happening is it's pulling ahead buyers. Vehicle buyers have been rushing out to market to buy ahead of these tariffs. And so some of that pull ahead demand is going to come back to haunt us a little bit over the next couple of months. And both the new and the used vehicle market are looking at rising price pressures. And these tariffs are going to be just adding fuel to that fire. So we may see prices rise a bit for both these markets over the summer. And so our forecast for the year, as it stands right now, is we're expecting the new vehicle market to finish down a little bit from where it finished last year, but we're expecting the used vehicle market to finish up a little bit. But both of them are going to be getting impacted by what's happening with tariffs. So let's just review where we're at right now. This is a chart that's showing the consumer price index, and this is the year-over-year inflation rate. And long history here, about 70 years worth of data, 60 years worth of data. And you can see where we are on the far right. Inflation has come down substantially from where we were at in June of 2022. And that's when we saw sort of that post-COVID inflation surge hit the U.S. economy, caused a lot of fear in consumers. Gas prices spiked to $5 a gallon across the country. The Fed started raising interest rates in order to start to slow the economy and bring the inflation rate down. And that has succeeded. You can see inflation has fallen dramatically since then. The latest data point from April was at 2.3%, but we're still a little bit above that Fed target of 2%. But this is what many folks are watching, because the Fed wants to get this inflation rate down so they can start lowering interest rates again. And one of the concerns folks have is that the incoming tariffs are going to be putting pressure on this in the wrong direction. And that's one of the reasons the Fed is having to wait right now in terms of any additional rate cuts. We can look at the unemployment rate. That looks really strong right now. Again, we've got 60, 70 years worth of data here. The unemployment rate right now stands at 4.2%. Historically, you can see that we're looking at a very low level. The U.S. economy hasn't really enjoyed such a prolonged period of low unemployment like this in many years. And the unemployment rate's been stable for the last year, at around this low 4% rate. So there's really nothing here to say that we're going to be hitting an iceberg anytime soon. And in fact, when we look at job creation, that's maybe the most important indicator out there is the economy adding jobs? Well, the most recent data points we have on that is that, yes, it's still adding jobs. So we had 177,000 added in April, well above about the 150,000, give or take, that we need to make each month just to keep the unemployment rate stable. And so, uh, job creation is still suggesting the economy is looking quite strong out there. But things have been changing over the last few months that are indicating that the economy is going to start moving in a different direction. One, we've seen a surge in imports. And I should preface this. If you look back at how we calculate gross national product or GDP, it's consumption, it's investment, it's government spending, and it's net exports. That's C plus I plus G plus X minus M, if you remember your college econ textbook. And we've seen that a lot of the factors that go into calculating GDP are starting to move in the wrong direction. We've seen a surge in imports. We've seen a massive drop in consumer confidence, which is going to hit consumption. Business investment has been basically frozen in the wake of these tariffs and what the president's policy is and is not going to be. We've seen the Doge layoffs and spending cuts that have hit government. And we've had first quarter GDP numbers showing that the economy is slowing significantly. In fact, it was negative. So even though job creation today is still positive, there are signals out there to suggest things are going to start to get worse. And one of the main reasons folks are really starting to get pessimistic is consumer sentiment. And this is a chart from the University of Michigan. They survey thousands of consumers each month and ask them, what is your outlook for the US economy? And again, long history of data here, over about 50 years. And you can see where we are today there on the far right. We are just above where we were in June of 2022, and that inflation rate hit 9% on that previous slide. But that's a historic low. In June of 2022, the consumer sentiment measure hit the lowest level it ever has in its history. And that's going back over major economic events like the double dip recession of the early 80s or the 9/11 terrorist attacks of the early 2000s. Where consumers are at today has fallen significantly from where we were just a few months ago. We had started a recovery from June of 2022 as the inflation rate was coming down and consumers were starting to see a little bit of relaxation of growing prices. But once the president started announcing his new tariff policy, we've seen consumer sentiment just drop like a rock. And that's where we are today. You can see it's fallen substantially. And this is important because we need confident consumers to go out there and take a $50,000 car loan to go out and buy a new vehicle. If people are not confident about the economy or their own economic futures, they're much less likely to make a big purchase like an auto. So this is a critical factor for us. The other interesting thing is when you look at this by political sentiment, there's really such a substantial divergence out there of how our fellow countrymen see the economy right now. This is a chart from the University of Michigan looking at consumer sentiment by political affiliation. And what's really interesting to note here is that around elections, depending on whose candidate wins, people flip-flop on their view of the economy. If you're a Republican in 2020 and your candidate lost, you immediately see the economy is doing terrible. While if you were a blue state person and Joe Biden won that election, you immediately are more optimistic on the US economy. Well, we just had the election last fall on the far right there, and you can see that we had a flip-flop again, that blue state folks are now very, very pessimistic on the outlook for the US economy. And independents, that purple line, has also gone negative. But you can see that people who lean Republican are still holding on, fairly optimistic as to where the economy is right now. And so, but it has started to wane a little bit. And to me, that does suggest that maybe there's some cracks starting to show in President Trump's support, for these tariffs. Because I think this movement that we're seeing here is directly related to that policy. So I only point this out because it may impact the type of consumers that are coming into your dealerships right now and who's buying. Generally, your red state folks still see things as pretty positive out there. We also were able to ask our dealer network out there what their view of the economy is right now. We do that with our dealer sentiment index, and we just got our second quarter results. And one of the questions we ask is how would you describe the current market for vehicles in the area where you operate? And you can see in blue, those are franchise dealers, and in orange are the independent dealers. And franchise dealers still remain fairly optimistic. They're well above 50. They actually ticked up to 56, while independent dealers are actually a little bit more pessimistic out there. They're not quite as optimistic as to where the economy is right now. We also asked, what do you expect for the market for vehicles in your area 3 months from now? And there we can see there is some agreement that in general, both franchise and independent dealers are feeling more pessimistic on what the outlook is for the vehicle market over the next couple of months. So they're kind of falling in line with what consumers are, and that is this fear around what the implications are going to be from these tariffs. And so we asked the dealers, what are the factors holding back your business right now? And the number one item that was cited by dealers was the economy, and that's moved significantly higher, suggesting that more and more dealers are concerned about the economy and its impact on the vehicle market. And you can see the political climate and tariffs on vehicles both making huge increases. And in fact, you can see that tariff went from basically being a non-issue in the first quarter to all of a sudden being a major issue there in our current quarter. And interestingly, you can see limited inventory has also become an issue. And that's something we'll talk a bit more about in just a moment. But the inventory situation out there is getting quite lean. So another reason to be concerned out there is that the vehicle buyer is stressed right now, and consumers in general are stressed. Their finances, as a result of these rising interest rates the last couple of years, is squeezing consumers, and they're having a hard time making some of their loans. This is a chart that is showing the 60-day severe delinquency rate on automotive loans. And in blue there is all loans, and then in red is showing subprime. And really the key takeaway from here is you can see that where we are today for these delinquency rates is above where we were during the Great Recession. So there's a lot of hurt out there right now, folks having a difficult time making payments on these loans. And in fact, we are in an area similar to where we were during the Great Recession. It's really spiked up the last couple of years as these interest rates have started to increase out there. This is putting a lot of pressure out there, and it may cause some limitations in being able to get financing. The silver lining of all this, though, is that even though we have elevated delinquencies, they have not fallen into defaults. People are late on their loans, but they seem to still be able to make those payments, and these loans have not fallen into default just yet. And that's what this chart is showing. You can see, again, that blue line is all delinquent accounts, but the orange line is showing the default rate, and that still remains below where we were during the Great Recession period. It's elevated, and it is trending higher, but because we have a much better composition of vehicle loans right now, over the last few years, the lending to subprime has been a much smaller portion of the vehicle market. As the credit quality of the buyer, we've been getting more higher income buyers in the vehicle market. That's insulated us a little bit from these loan defaults. And so we're in dangerous territory, but it's no crisis just yet. But it's just one of these things that folks are looking at to saying that the vehicle market is in for a tough time here the next few months. The other thing we like to look at is credit availability. How difficult is it out there to get credit to be making big purchases or business activities? This is a chart that's showing the loan officer survey from the Federal Reserve Bank, and it is showing they survey hundreds, thousands of loan officers around the country and ask them, is your bank making it tightening the standards for the loans that you're making? And if you're above the zero line, it means yes, our bank is tightening standards. We're making it more difficult to get approved for loans. And if you're below that zero line, it means no, we're loosening the purse strings. We're going to start letting more money flow out of our bank. Well, you can see that where we are more recently is that it had been tight. As interest rates went up, we can see that lending to the dark blue line, and that's lending to new and used auto loans, as well as commercial and industrial loans for medium, small, and large firms. That all tightened when we saw the interest rates started to rise. And that was because we knew that borrowers were going to have a more difficult time in making those payments. But it had been loosening over the last 2 years or so. But you can see the most recent data points are showing a bit of a turn for commercial and industrial lending out there, even though auto loans are still doing okay, as well as mortgage loans. But the broader economy does look like it's starting to tighten just a little bit. Again, just one of those signals to suggest things might be slowing down. So all of this means that we're not getting the loan rate cuts that we had been hoping for. This is a chart that's showing some of the key interest rates in the economy. And that dark red line is showing the federal funds rate. And that's the rate that the Federal Reserve Bank can use to raise or lower the overnight lending rate. And that kind of dictates the overall interest rate in the economy. And they started to lower it about a year ago, but they had to pause, and in part because inflation had been a little bit sticky, and now more recently because of the president's new tariff policy. Ideally, people were expecting the rates to be cut probably another 50 basis points this year. There is still expectations we're going to get another rate cut in the fall, but the pace of these rate cuts has been slowed substantially because of the concern about the potential of higher inflation coming as a result of the tariffs. And as a result of that, we're seeing that auto and used loans still remain pretty elevated. The interest rates, they have not come down very much. And so we're not going to get a lot of help on the lending side here as we look for the second half of this year. So all of this means that the new vehicle market is really kind of coming off of a very strong selling period, but we're expecting the sales pace to start to slow substantially here over the next couple of months. This is a chart that's showing the light vehicle sales SAR, and we just got the May number a couple of days ago, and we finished with a 15.6 million sales pace. That's basically the average of what we've been doing over the last 2 years or so, but it's a far cry from the 17.8 million and the 17.3 million pace we did back in March and April, just a couple of months ago. And that's that big spike you can see there on the slide. That was all that pull ahead activity. Once the president announced those tariffs, a lot of folks rushed out to buy. But now that we're into May, a lot of that pull ahead demand has been satiated, and we're starting to see that prices are starting to move a little bit out there, as well as leaner inventories. So the sales pace has come down in May. We're expecting that we get into June and July and August, we're probably going to see the sales pace move even slower. So our year-end forecast, we have quite a range of, does the president get rid of these tariffs, tomorrow, or does the president go even full throttle more on these tariffs? We've got sort of a 15.3 million to a 16.3 million range. Our expectation right now is by the time we get to year's end, the market's going to finish somewhere near 15.7 million, or down about 1% from where we finished last year. And really, that's from having we had a strong first half of this year so far. It's really that we're expecting a weaker second half. And that's because of these tariffs. And I don't even know if this chart is up to date, given what might have happened even today. But the president has announced sweeping tariffs across the economy, but some of them very specific to the automotive industry. But just to highlight some of these, he's now launched a steel and aluminum import tariff of 50%. It was 25%. That alone may add anywhere from $500 to $1,000 to the price of a vehicle. China imports were at 145%. Well, now they've been moved down to 30% temporarily while they're trying to negotiate a deal. And apparently they just spoke this morning, the president of the United States and China. So they're still talking about it. We also have auto imports, 25% on every vehicle coming into the country, although the UK is getting a bit of a discount at just 10% on their first 100,000 vehicles. The implications from that are massive for the automotive industry. Our back of the envelope calculations estimates that could add almost $4,000 to the price of every vehicle out there, or adding about 8.2% to the average transaction price. So the implications for the industry are going to be substantial. And then you get into adding auto parts, which could add another $1,000 or so. EU tariffs have been jacked to 50%, but that's until July 9th. It's on pause until July 9th, so we'll see what happens with that. But really, the implications are going to be substantial. As I said, the implications of all of this in the short term has been we've seen a sales surge, a lot of folks coming out to buy before these prices start to hit the market. We know that manufacturers have been cutting back on their incentives and their discounting because their existing inventory is now worth more. There's not as much of a need to get rid of it. We know that auto suppliers are under stress. A lot of them don't have the money lying around to pay these tariffs when they're trying to fulfill programs that they've bid on. And so there's all kinds of issues, and we're going to start to be looking at production issues. And that's one of the concerns that we have over the summer. There's a lot of talk that the Chinese have made the export of rare earth metals, particularly magnets that are necessary in the production of vehicles. They've restricted some of that going into the U.S. so that we may see production delays across the industry here in coming weeks. It's just hard to know how severe that is going to be. But there's a lot of disruption that is coming, and who's vulnerable from it really varies quite substantially. This is looking at 2024 sales of all the different major manufacturers, and where did their portfolio come from? Where were these vehicles manufactured? And you can see that the new battery electrics, Lucid, Rivian, Tesla, they're 100% American made, so they're not vulnerable to these tariffs. They're 100% in the U.S. You can see Ford and Honda, at least among the other manufacturers, are a little bit better off because they make quite a few of their products within the U.S., but they also import from Canada and Mexico. And then by the time you get to the far right, you can see there's a lot of companies that manufacture almost entirely offshore, like Mazda and Volvo and Tata. These companies are going to be very, very vulnerable to these tariffs. And just to give you an idea, again, back of the envelope kind of calculations, we went through and tried to figure out, looking at year-to-date sales through April of this year, if tariffs had been in place, what would be the average transaction price and the additional tariff amount that would be added to that based on the mix of vehicles and where they're coming from. And you can see here it's quite varied in terms of who's vulnerable and who's not vulnerable out there. Again, you can see Lucid, Rivian, Tesla, they're really not any assembly tariffs that are going to be placed on them. Ford Motor Company, just a very small price impact as a result of these tariffs. But you can look at other manufacturers like Toyota at 11%, Geely 18%, Mercedes 13%. Really, a lot of manufacturers are going to be very, very vulnerable from this. And we're going to see, the longer these tariffs are in place, we're going to see manufacturers have to make substantial strategic decisions. Certain products getting cut, just leaving certain product segments almost entirely. And they have to decide, do we apply the tariffs just to the vehicles that were impacted, or do we spread the cost exposure across our entire portfolio? Or do we eat that cost, as the president wants us to do? A lot of things to be decided out there. But one of the things to look at is, if these tariffs had been in place, where does the burden of these tariffs lie? And I looked at what has been the year-to-date market share through April, and that's that green bar. And then what share of the total collected tariffs, had they been in place, would those customers have been paying? And this gives you an idea as to who's really paying the brunt of these tariffs. And what kind of pops out here is you can see that General Motors and Toyota customers are generally paying a greater portion of the tariffs than what the actual market share is of these companies. But where it really jumps out is Volkswagen and BMW and Mercedes. Those customers are going to be paying a much greater portion of the tariff. And you can see Ford Motor Company and Tesla, on the other hand, they have a large market share, but yet very little, their customers have very little exposure to those tariffs. So we're going to have winners and losers as a result of these tariffs, and we're already starting to see some of that in the market sales results. I'll show you in just a moment. The other interesting thing about these tariffs is that they're pretty regressive in terms of how they're going to tax consumers, meaning that the poorest folks are going to be paying the greatest percentage of tax. So if we look at the biggest product segments out there, you can see compact car, subcompact SUV on the far left. These are some of the most affordable product segments they have, with average transaction prices in the low to mid $30,000 range. With these new tariffs, they're going to add about 17% to the average price of these vehicles if the tariff is passed on entirely. And that's because these product segments are almost entirely manufactured offshore. We can't manufacture these small SUVs, small cars, because we just don't, the profit margins are so thin on them, we can't have an industry that can support that. And so this is why they get imported offshore. So again, kind of regressive and may not be the intended objective of these tariffs, but they are going to hit the most affordable products the most. So what does all this mean for the vehicle market? Well, it means quite a bit, and we've seen a strong reaction in the marketplace almost immediately. This is coming from our vAuto data, and this is showing basically the sales tracker of what we're seeing in the new retail sales activity and used retail sales activity. And in blue there, I'm showing what happened in 2023 over the course of the year. And then in green is what happened in 2024. And then in red is this year. And you can see that in this spring, basically once the president made that announcement at the end of March, we just saw a rush to market, and particularly on the new vehicle side. You can see that we saw a massive surge in vehicle sales, again, hitting the fastest pace that we've had since 2021. And we saw an equal response over in the used market because of fears that consumers have that these prices are going to start to rise. So they wanted to get out there today. But that surge is now in the rearview mirror, and it's coming down. And this, as a challenge as a forecaster, like myself, the challenge is well, where are we at now? It's clearly trending lower as we move forward in time. How much further down does it move, or does it level off to where we, equal to where we were last year? And that seems highly unlikely that we're going to sort of level off at an equal playing field to last year, because we got a whole different world today, which is one that's going to have all of these tariffs in place. So we have to assume that there's going to be some sort of negative consequences to that. And we've seen some activity out there already. Just looking at the shifts and what folks are buying out there, I pulled the data looking at March, April, and May, and what was the market share of these different OEMs versus what their market share was in January and February. And there is a little bit of a seasonality effect here, because some luxury brands don't do quite as well in the early months of the year, because generally, Christmas time is their big sell season. But what does emerge from here, I think, makes sense, and that is that we've seen very strong gains in market share from Toyota and Ford and Hyundai. Their market share increased, 0.8% in March, April, and May from what they were doing in January and February. And where's that market share coming from? Well, you can see, Tesla, Volkswagen, Nissan, these companies are seeing that higher prices may already be hitting them, and consumers are shifting their preferences towards manufacturers what they really want to buy, and they're concerned those prices are going to go up real quickly. And so it's having ramifications right away. So just looking deeper at the new vehicle market, the issue we're dealing with right now is supply. And it's changed dramatically. It's gotten very, very tight out there. This is from our vAuto data. And on the left, you can see this is a chart that's showing the available supply, or what is on dealer lots across the country each week of the year. And where we stand right now, we're close to about 2.5 million units, far below the 3.2 million we had just in December. It's really come down dramatically, and where we stand today is about 12% fewer than what we had on dealer lots a year ago right now. So the market is back towards sort of late 2023 levels, which was when you had very strong margins and inventory was very tight. And so again, that's going to be putting pricing pressure on vehicles here, and it's already starting to happen. On the right here is days of supply, or how long will that existing inventory last based on the current sales pace. And you can see that it's fallen dramatically from where we were just a couple of months ago. It's gotten tight quite a bit, but it is starting to rebound a little bit. And the days of supply has now cracked back up to 70. But that, again, you can see it's not from a surge in supply out there. It's because we're seeing a fall off in the demand side, that surge of demand is now past. And so the pace is slowing. And so the days of supply is going to last a little bit longer now. But make no mistake, it is still pretty lean out there. And it varies greatly by the different manufacturers in terms of how lean they actually are. This is a chart that's showing that vAuto data for the different brands. And you can see nationally, days of supply is about 70. But on the far left, you can say Toyota, Honda, BMW, their days of supply is substantially tighter. They don't have as much inventory versus their counterparts on the far right. You can see Jeep, Hyundai, Ram with quite a bit more days of supply. And we would assume that in that type of environment, those brands with the tightest inventory are going to be the tightest on incentives as well. They're not going to be as aggressive on discounting because they don't need to be. They already have lean inventories and the products are selling well. Versus on the far right, we would expect many of these brands to have to start discounting aggressively in order to keep up in this type of environment. And so overall, we are seeing that the incentives are changing out there in the marketplace, and they're probably going to change even more here over the course of the summer. But this chart is showing what we measure in incentives with our Kelley Blue Book data. And the dark blue line is showing incentives as a percent of the transaction price. And we can see back in 2019 and early 2020, before COVID, generally this ran in the 10 to 11% range. Then when we got into the very lean inventory times of 2022 and 2023, we can see that this fell to a very, very tight level of about 2%. Then as the inventory recovered over the last couple of years, this has recovered as well, and incentives rose to about 8% back in in December, but now they've started to fall again, and they're likely to fall further as the inventory levels are being drawn down. The other measure we have on here is price strength, or what is the transaction price relative to the MSRP. And that's what that green line is. And you can see that back before COVID, this ran sort of in the 94, 95% range was the price strength. Then when we got into the lean inventory period in 2022, this peaked at about 102%, where the transaction price plus the delivery cost was the price of the vehicle. There was no negotiation to be had. But as inventory recovered, so did this metric, and it fell dramatically. But where we are today, it stands at about 96%, and it's sort of flatlining, not moving any longer in the buyer's favor. And so we would expect that the marketplace out there is starting to shift away from buyers and back towards sellers. And that would suggest that we're going to see even fewer incentives here over the course of the summer, and margins may actually start to strengthen a bit, even though we're in sort of going to be in a tighter sales environment. And overall, this is all putting pressure on higher prices. And on the left here, this is from Kelley Blue Book, showing the average transaction price out there in the marketplace. Our April, our most recent data point, I don't have May just yet, unfortunately. We're standing at about $48,700 is the average price. And this is well above what would be normal sort of in the pre-COVID market. That dotted line is showing the where prices would be today, sort of had COVID not happened. And if we continued on the previous trend of about 3% price growth per year in the new vehicle market. We're well above that now, about 10, 11% higher than where prices would be otherwise. So there still is this feeling that prices do remain elevated out there in the vehicle marketplace. And certainly higher tariffs are going to only add more pressure to that. And on the right, we can see the annual change, or the inflation rate of vehicle prices. And what's a key takeaway here is that you can see that during pre-COVID, we averaged about a 3% inflation rate in the new vehicle market. Once COVID came and we had the lean inventory period, we saw new prices really start to surge, but they've been coming down over the last 2 years. But where we stand today, you can see they're now starting to show strength again, and they're starting to move positive. And our expectation is, as we get through the course of the summer and into the fall, we're going to see that these tariffs are going to be putting more upward pressure on prices, and we're going to see less discounting, fewer incentives, and all of this is going to lead to a return of inflation, significant inflation in the new vehicle market. How significant does it get? It's hard to say just yet, but certainly higher than where we are today. And this is true for the used vehicle market as well. This data comes from our vAuto data, and it's showing the average used retail list price there on the left. And you can see where we stand today at about $25,547, down from the peak of about $28,000 that we had back in the lean inventory period of 2022. But the key takeaway from this is what's happening on the right, and that's the inflation rate, or the year-over-year change in the average list price. And what we can see is that after a couple of years of prices actually falling, they're now about to start to turn positive again, suggesting that inflation is going to be returning to the used vehicle market. Certainly not like what we had back during the lean inventory period, when we had inflation of 20, 25%. Hitting used vehicle prices, but higher than what we are looking at today. And so that's kind of what we're suggesting that folks be prepared for. And our own forecast is, when we look at the Manheim Index and where used vehicle values will be at auction by year's end, we're expecting that come December, we're going to see more of a return to normal of what we're seeing at auction. It's really been quite volatile the last couple of years in the used vehicle market, where during the COVID year, we saw 14% price growth. Then in 2021, we saw this massive near 50% increase in prices at Manheim at auction. Then we saw, the years of negative activity in 2022 and 2023. We finally eked out a minor gain in the used market at auction there in 2024. And we're expecting when we get to 2025, by December, we're going to be back more in sort of the normal range. But again, that's all contingent on things not getting too crazy with the used vehicle prices here in the next couple of months. But the other thing we're looking at that's sort of next on the block for what the president has in store for us is the Inflation Reduction Act. And Congress just passed, the House passed a bill last week, and the Senate is now waiting to vote on it, which eliminates certain parts of the Inflation Reduction Act, including the $7,500 tax credit. And that's been a very important part of the vehicle market for the last couple of years, as this chart shows us. This is showing a leasing share of retail sales, and split it out here by fuel types as well as the overall market. And the key takeaway here is what's happening there in the purple and green lines, and that's plug-in hybrids and battery electrics. And the leasing rate since the passage of the Inflation Reduction Act in the fall of 2022 has really taken off. And that's because manufacturers have been taking that $7,500 tax credit and applying it as a capital cost reduction and allowing them to offer very subsidized leases. And these low cost leases have been really moving the needle on the strong sales activity that we've seen for plug-in hybrids and battery electrics the last couple of years. If the president pulls back on that $7,500 tax credit, as is currently written in at the year's end, it's very likely, almost certain that we're going to see these numbers fall back sort of to certainly pre-COVID levels and maybe even lower as the market sort of shuns these products altogether here. And it seems very likely that if these products if it goes through and they do get rid of the $7,500 credit, we'll probably see a surge of activity here for the remainder of the year as manufacturers and dealers and consumers and everyone tries to take advantage of that tax credit before it goes away. So that part's a little bit unknown, but that's kind of what we're dealing with as to sort of what's coming down the pipe next. The other thing we know is that there's going to be a whole bunch of used lease vehicles coming back to market here in the next couple of years, regardless of what the president does. And this is a slide that's showing the lease maturity outlook by fuel type. And so what is the number of off-lease vehicles that we're expecting to come to auction in the next couple of years? And you can see that we're expecting a big downturn so far this year in 2025. It's going to be very few off-lease vehicles because of the lean sales activity that we did back in 2022 and 2023. But as this is going to recover, we're going to see more off-lease vehicles in the next couple of years, reflecting the recovery that we had post-COVID and sort of that 3-year lag that it takes to see this in lease maturity data. But the composition of the vehicles that is going to be maturing changes substantially. And by 2027, we're expecting about 500,000 used EVs to be coming to auction and off-lease that year. So there's going to be a lot of off-lease vehicles coming, and that's something that we're telling a lot of dealers to just be prepared for because there's going to be a lot of these alternative products for consumers to choose from here in the next couple of years. And depending on what the president does with that tax credit, we may see some big changes in retention values. And this is really the last slide that I have. This is showing the retention value of 3-year-old vehicles. And it's sort of a back of the envelope calculation as to how much of their original MSRP do vehicles hang on to over the course of their life over 3 years. And the key takeaway from this slide is that you can see hybrid vehicles after 3 years generally have about 70% of their original MSRP value at auction. You can see the red line there is showing that ICE vehicles, internal combustion engine vehicles, have about 65% of their original MSRP value. But today at auction, you can see in green that electric vehicles are sort of near 40%, much lower retention values than some of their competitors out there. And this is due to the massive discounting that we've seen in battery electrics over the last couple of years, as well as the $7,500 tax credit, state credits are coming from Colorado, as well as California. All of these, and of course, new product and technology developments, all of these things put a lot of negative pressure on vehicles holding their value over time. And this is certainly true for battery electric vehicles. However, if the president gets rid of that $7,500 tax credit, we might just see that green line shift upward quite a bit, because all of a sudden, used electric vehicles are in a sense going to be significantly more valuable, because the new version isn't going to be discounted as much. And so and certainly the used $4,000 EV credit goes away as well. And so that won't be hindering EV retention values. So just something to keep an eye on. We're going to have a lot more EVs in the future. And depending on how Congress votes on this tax credit, they may be worth a little bit more than what we're currently expecting on them. So a lot of changes has been happening and a lot more change to come. But I would suggest to you that this summer might be a rough couple of months. We're going to see quite a bit of concern out there. I think we're going to see some data and reports about production issues and price increases and all kinds of things like that that are not going to be positive news for the auto market. But we're still on a pretty sound foundation to have a year where overall the year is only going to finish down just a little bit. So that's my comments. If you're looking for additional information, Cox Automotive is always publishing news stories and reports all the time on our newsroom, and that's at coxautomotive.com newsroom. And we have all kinds of other sources there as well if you want to get up to date on what's going on in the automotive industry. And if you have any comments or questions for me, please feel free to contact me. As Rachel said, they're going to be distributing this presentation, so you can have a copy and get a chance to look through it. So those are my comments today.
Charlie, thanks for always coming on and helping us stay informed. We really appreciate you in these webinars. Again, like Charlie said, you'll all be receiving a copy of this presentation and recording by early next week. This was our last webinar of the spring season. We'll be back September 11th with Charlie as he returns to update us, and I'm sure he'll have a lot more after the summer, and kick off our fall series. So thank you all for joining us this season, and have a great summer.